Capital gains and dividends are both forms of investment income but arise from different sources and have distinct tax treatments. Here's a breakdown of the differences between capital gains and dividends. Definition: capital gains. Capital gains refer to the profit earned when an investment, such as stocks, bonds, real estate, or mutual funds, increases in value and is sold for a higher price than its purchase price. Dividends. Dividends are payments made by corporations to their shareholders as a distribution of profits. They represent a portion of a company's earnings and are typically paid regularly, e.g., quarterly, to shareholders. Source: capital gains, generated from the sale or disposition of capital assets, such as stocks or property. It reflects the difference between the purchase price, cost basis, and the selling price. Dividends, paid out of a company's profits to shareholders as a reward for holding their stock. They are usually declared by the company's board of directors and distributed on a per-share basis. Tax treatment. Capital gains, taxed based on the holding period of the asset. Short-term capital gains, assets held for 1 year or less, are taxed at ordinary income tax rates. Long-term capital gains, assets held for more than 1 year, benefit from preferential tax rates, which are typically lower than ordinary income tax rates. Dividends, taxed as ordinary income, unless they qualify for lower tax rates on qualified dividends. Qualified dividends are eligible for the same preferential tax rates as long-term capital gains if specific holding period requirements are met. Timing of income. Capital gains, realized when the investment is sold or disposed of, triggering a taxable event at that point. Dividends, received periodically based on the company's dividend payment schedule. They provide ongoing income without requiring the sale of the underlying investment. Risk and return. Capital gains, realized based on changes in asset prices and market conditions. They reflect the potential for appreciation or depreciation in the value of investments. Dividends, represent a direct distribution of a company's profits to shareholders. They offer a stable income stream and are less affected by short-term market fluctuations compared to capital gains. Investment strategy. Capital gains. Investors may focus on capital gains by buying assets with the expectation of price appreciation over time. They often engage in strategies such as buy and hold or market timing to capture gains. Dividends. Investors seeking regular income often prefer dividend-paying stocks or funds. Dividend investing can provide a steady income stream while benefiting from potential capital appreciation. Understanding the differences between capital gains and dividends helps investors tailor their investment strategies, manage tax implications, and optimize their overall investment income based on their financial goals and risk tolerance. Each form of income has distinct characteristics that influence investment decisions and portfolio management approaches.